a few years ago, Trump announced or tweeted that he paid $750 that year in federal income tax. People were up in arms and really, really not happy. When you do a cost seg and you do 1031 exchanges, there's no reason, if you have enough property, to be paying federal income tax. I always ask, why did Trump even pay $750? You should have paid zero. So he got away with it legally by doing cost segregation studies and 1031 exchanges. You can do it too.
All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an interesting guest here today. We have Isaac Weinberger. How are we doing today, Isaac?
We're doing well. When I'm chilling with Aaron, all is good.
Thank you, my friend. Thank you. The tax professional, the specialist, the LinkedIn celebrity here. Oh my gosh, what a hot topic on the internet you are. You are the pro of helping people avoid paying their taxes. That's why you're on the Passive Cash Flow Podcast today, my friend.
Appreciate you inviting me on, Aaron. I'm not as big as you're making it sound. Try to stay humble, but thank God, definitely get to connect with some great guys in the space and help them out, save a lot on taxes. And I'm so excited today to share that with the audience.
Absolutely, my friend. Absolutely. And by the way, to our listeners, as you know, here on the Passive Cash Flow Podcast, we have tons of exciting guests on that talk about how to build your wealth and diversify your wealth, often in real estate, tax specialists like we have today. So if you're enjoying this content, make sure you share it with a friend. You like it on the podcast platform or on YouTube that you're watching us here. And you can subscribe as well. We come up with a new podcast now every 2 weeks. So be sure to check us out there. And we're putting out a lot of more content on YouTube these days. So you can follow us there on YouTube, People's Capital Group, or the Passive Cash Flow Podcast. And so, Isaac, let's get into it here, my friend. We've had different tax specialists before on the show here, and we'll go over what a cost segregation study is in a few minutes to remind our listeners if they hadn't caught some of those past episodes from a while ago. But before we get into that, we use you for our cost segs, and that's why I want to have you on here as well. We actually, bring on companies that we really select to work with, so we know they're good companies. What separates you from other cost seg companies out there? What makes you guys different?
I love that question. It gives me the opportunity to really delve in and teach guys like you in the audience exactly what's really at stake. And yes, I say what's really at stake because cost seg is not just a cherry on top. I'm a big believer that cost seg is a solid appetizer. It might not be the main course. Debt, title, insurance is extremely important, but cost seg, if played right, if you play it the right way, you play your cards right, you can leverage it to raise money, so on and so forth. So the minute synopsis I always like to give new prospects is that historically cost seg is not a relationship-based item, and it's not either an item that is really expounded upon. It's really, hey, I bought this property for X amount of dollars. We're going to go do a cost seg, call it a day, see you next time. Similarly to walking into Walmart, buying your case of water. When you finish it, you got to go back and buy a new one, right? You might go to Target, you might go to Walmart. It doesn't really matter. The water is the same. Folks out there think that cost seg is cookie cutter. I'm a big believer that cost seg is the farthest thing from a cookie cutter item. I think it's actually the opposite when it comes to, let's talk about title insurance for a second. That really doesn't change from one property to the next. Obviously, there could be liens, there could be foreclosures, but in terms of insuring the property, it's very, very similar. When it comes to cost seg, you could have one guy purchase 123 Main Street, and you could have another guy purchase 123 Main Street at the same exact price, the same exact day. But one guy would benefit from a cost seg and one guy wouldn't. One guy's going to benefit because he's a real estate professional, which we'll talk about. Another guy won't benefit because he's not a real estate professional. One guy will benefit because he has a tax liability and his investors want it. One guy won't. Having a guy who really understands the nuances and details of the ins and outs of cost seg is so, so important. And something that I brought to the table, which maybe we'll talk about later as well, is something that I've taught my clients how to use the depreciation benefits to leverage and raise equity. Because if you can go to a potential investor and tell them, hey, you're going to get X amount of dollars in losses per this amount invested, not only does it make them happy, but it gives them the ability to potentially invest more. Or it gives them the ability to invest more in the next deal. right? Also, it gives them the ability to choose between two deals that have the same IRR and cash flow projections, but one has more depreciation benefits than the next. That could be a game changer. So teaching my guys exactly how to leverage it in every single scenario. Talk about pre-reno, post-reno. And when it comes to commercial properties, QIP, qualified improvement property, I could talk about cost seg for days. Having a guy that really knows the ins and outs and will go to bat and fight land values to make sure that you get every single ounce of depreciation, that's something you're not going to get everywhere. On top of that, just try to provide as much external value as possible. Host events, sponsor clients' events, really be there, not just be a taker. So trying to revolutionize the space. Thank God I get to work with some great guys like Aaron, some local guys, some national guys, some big firms. Thank God we picked up a few multi-billion-dollar investment firms, and it's been a true honor. And I love doing what I do. I try to be honest and just bring my best game every single day.
I can see that. You're a very good businessman. I've enjoyed our business relationship and the lunches and the little gadgets you send me in the mail and stuff. You're very good at what you do. I could take a page out of your book, in fact, with what I do too, building relationships with investors and so on. You always seem to be on the forefront, whether it's I'm clicking on the LinkedIn or I'm charging my phone with the wireless charger you sent me, or just enjoying some sushi here. That was some very good sushi, the best of Lakewood, New Jersey there. Very excellent. Although it got me off the keto diet and totally destroyed my carb intake for the day and got me out of ketosis, and took me probably a good 2 days to get back into it. But yeah, it's all your fault. Yeah. So between fasting though and my keto, I think I'm back on track, except for the wedding I was at yesterday. That was not good. So anyway, keto's 2 steps forward, 1 step back. That's a whole different podcast. So let's break into it here. We've kind of, like I said, covered a little bit. What I want to get into is the nitty gritty here of cost segregation study. A lot of people don't even realize the value of it, the benefit of it either. I mean, when I started, raising capital to buy apartment buildings, I didn't even talk about the tax benefits because I didn't really fully understand them. I thought, oh, you just get straight line appreciation. You break it out over 37 years or 27 years, depending on, what it is, or 39 years or 20, but then I started to realize, wait a minute, you can get a study done and you can front load a bunch of tax depreciation and get a huge tax write-off in the calendar year that you buy that property, and use those tax write-offs to write off other gains, which is essentially what a cost segregation study is. So, but I want to get right into the heart of it here, because what confuses investors is the passive tax bucket and the active tax bucket, right? I have people come to me all the time and they say, hey, I'm a doctor and I earn $500,000 a year, and I get nailed on my W-2 taxes. Can I use, I see your advertisement, so you get a 25% tax write-off. So on a $100,000 investment, that means I get a $25,000 tax write-off in the year that I invest. Like, that's incredible. Does that mean I could use that $25,000 tax write-off to write off my W-2? And I have to explain to them the different tax buckets and disappoint them a little bit. But there's different kind of rules and regulations there, different ways around it. So let's break into those tax buckets if we can. And I'll let you speak with your tax wisdom here about the different types of tax write-offs. If you're an active, you own a business, you're getting tax on your active gains. And here you are investing in a syndication as a limited partner, as an LP, getting passive tax write-offs. How can you marry those? Is there any way to marry them, or are you forever separated in different tax buckets? Okay, go.
I love it. This is a very, very important conversation. But first, we're going to pause for a station identification break to give a shout out to PCG, to the audience that will be listening to this podcast. PCG are multifamily syndicators led by my good friend Aaron over here, the host. And if you're looking to play some cash, Aaron is an honest and good man. I've met him, I've dealt with him, and there's a dime a dozen when it comes to syndicators. Right. Somebody who's going to really trust your money and deal with your money as if it's his own, somebody that you could really trust, just a good man, definitely guys that you should be talking to. That's number one. In terms of your question, let's begin like this. And we're going to get into your question in a second. I always like to start off by saying a few years ago, Trump announced or tweeted that he paid $750 that year in federal income tax. People were up in arms and really, really not happy.
Mm-hmm.
And they shouldn't be happy. You cheated the system. And the answer is anybody who knows real estate. Trump did it legally with the government's permission, and they're actually for it. When you do a cost seg and you do 1031 exchanges, there's no reason if you have enough property to be paying federal income tax. I always ask, why did Trump even pay $750? He should have paid zero. Mm-hmm. So he got away with it legally by doing cost segregation studies and 1031 exchanges. You can do it too. You want to save money on federal income tax, you can do cost seg, you can buy properties, invest in deals, and hopefully if you meet the criteria, you can qualify as well. That being said, the reason why the government does this is because the more they incentivize owners like Aaron and others to buy real estate, the machine is just oiled more and more. So you're going to take out loans, interest is going to be charged, the banks are rolling, everything is working in sync. So the more they incentivize folks, the more deals there are to be made, properties trade hands, banks lend out money, everything is great. So you're not cheating a system, you're actually doing everybody a favor. So keep at it, and this is the way to do it. The second thing I always like to say is, if I saw you walking down the street, okay, I'm going to make believe John is listening to this podcast. Maybe there will be a John listening to this podcast. So John, I'm talking to you. You're walking down the street, and I say to you, John, I owe you $100. Yes, I forgot to pay you back. I have two ways I'm going to give you two options how I'm going to pay you back. Number one, I'm going to give you $10 a year for the next 10 years. The second option is I'm going to give you $30 year one, and whatever the number is, let's say $7 over the following 9 years. Okay. Obviously, you're going to pick 30 year one. You'll take that money, buy some pencils on Amazon, flip them for a profit. Boom, you got some ROI in your pocket. You've got a nice return on investment. $1 today is worth more than $1 tomorrow. So essentially, you're getting the same amount of money at the end of the day, but it's a time value money play. That's what cost segregation is. I'm not creating more depreciation for you. What I'm doing is I'm front loading depreciation for you to give to yourself and to your investors and your partners. Lower the federal income tax rate on your NOI, give better returns to your investors by getting the depreciation benefits, being more well capitalized to buy another deal. That's the idea of a cost seg, time value money. After we introduce that concept for the newbies, or even guys that have been in the game for a long time but are not very well familiar with this concept, just something to take note of. In regards to Aaron's question, it's something it's extremely vast, but I'll try to simplify it for you guys as much as humanly possible. So a guy like Aaron and me are similar. We're both in the game. We try to be honest. We do deals. I do cost seg. He buys apartment buildings. There's a very, very big difference. Aaron's better looking than me, but besides for that, Aaron is a real estate professional. Isaac is not a real estate professional, which means if I would go ahead and invest in Aaron's deals, where I would buy my own single family, multifamily property, I would not be able to use those depreciation benefits against my regular W-2 income. Aaron can buy an apartment building, get a nice write-off, and use it against his regular income, whether that's acquisition fees, whether that's just income, the cash flow that he gets from the property, or even if he has a side hustle, let's say 2 hours a night, Aaron's doing stuff on Amazon, right? He can use his real estate professional status, which is a golden ticket, technically, and use that to offset his Amazon or whatever income he may have. I don't have that. So, and the reason why I don't have that is because I'm a W-2 guy, and even though I'm doing cost seg, it's not considered a real estate activities, even though I'm dealing in real estate. What's considered real estate activity is buying real estate, managing real estate, construction services. That gives you the status, reps, real estate professional status, which makes a huge difference because Aaron can syndicate a deal, or you can syndicate a deal. And what happens is you buy a deal for $10 million and I get you $2 million in depreciation year one. Okay. You have two investors on the deal. One guy's a real estate professional. One guy's not a real estate professional. The guy that's a real estate professional invested X amount of dollars. He's going to get X amount of dollars in depreciation. He can use that against any income. The guy who's not a real estate professional, let's say the doctor, won't be able to use it against his W-2, his doctor's income. So while the deal still might make sense and it's worth it to invest, of course, because you got cash flow, IRR, you're good to go. But that extra credit, you won't be able to utilize. So how can I help you utilize that? So what makes somebody a real estate professional is these activities that I told you. If you do them on a daily basis, most of your day, you'll be considered a real estate professional. There's really two ways to do it. Not two ways. There's two steps in order to gain that status. Mm-hmm. Number one, 750 hours a year or more in real estate. Number two, that you're spending more time in real estate than any other related activity. So if you're a doctor and you're spending 900 hours a year, you're probably spending much more. You're spending 3,000 hours a year being a doctor, and you're spending 750 hours a year doing real estate. It's not going to help you because you're spending more time being a doctor than doing real estate. So not only do you have to do 750 hours plus, you got to make sure you're not doing anything else more than that. That's why some people, and I'll advise, obviously I always say you need to ask your local Orthodox CPA. But you got to speak to your CPA, but maybe you can make your spouse into a real estate professional. Let's say your spouse is not working and you put their name on the investments, whether you're buying something and managing it yourself or whether you're investing in somebody else's deal. And you can track those hours that you're looking at and analyzing all these deals and investing and whatever else it may be that you're doing real estate related. Maybe you can make your spouse file jointly and use your spouse's real estate professional status to offset your doctor's income. So that's a smart way to do it if it's possible. There are ways to do it in a legal way. But on top of that, and this is something that's going to be more relevant for the listeners over here today, is that let's say you cannot make your spouse into a real estate professional and you're not quitting your job as a doctor because you're making a handsome income, right? So what are you going to do? You can use it to offset passive income. So if you invested in 10 of Aaron's deals, plus you invested in other people's deals, and you have a lot of passive income, you have some stock market proceeds, maybe you sold something, you had a capital gain, which a lot of CPAs consider passive. There's a big argument in the world if capital gains are considered passive or active. Even if you don't have rep status, I keep saying rep status. Reps is real estate professional status. So even if you don't have reps, you always can use depreciation to offset regular passive income. So some people are very smart, and what they'll do is they have a business, and they'll make their spouse into a passive partner in the business. So now, boom, I'm making $500 a year, and my wife is making $250 in passive income. I can use depreciation to offset that. So I love having these conversations with people. I have it all the time. I'm not saying it's easy as pie, but there are ways to maneuver if we're savvy enough to get it done. Definitely have the conversation, but just keep in mind, even if you don't have a conversation, but you're making X amount of dollars in passive income, you could always use those benefits. Now, for the syndicators that are listening, sometimes it actually works to the benefit of the syndicator if one of the investors or two or three can't use those benefits, because then it's considered a suspended loss for them, and you could actually somehow channel those depreciation benefits. If you structure the OA a certain way with your attorney and your CPA, you can actually go ahead and move those depreciation benefits over to somebody else, and now you're doubling his depreciation benefits, so he's more excited to come in on the deal because he's getting so much more benefit. So again, just to review, what's really happening is that it's never gonna be a problem for you, even if you can't benefit. You don't have enough passive income. You don't have real estate professional status. It's not going to be a problem. It's that extra credit that you just can't access. But again, have that conversation, and you could always offset passive income. But something I'll just end with by saying, if you are a real estate professional, there's no excuse for you to be paying a high tax bill to the federal government. You should do everything you can by investing in real estate, buying your own stuff, whatever it may be, whatever talks to you. You should go ahead and make sure that you're bringing down your bottom line, because we all spend so much time making money. How much time are we spending saving our money? Know what I mean? Yeah. So if you're going to make $1 million a year and you're going to give 30% or more to the IRS, there's no excuse for that. Go invest with people, because that money's invested. You might not have it in your bank account, but that money's invested. And now you got major depreciation benefits that will totally offset at least some or hopefully most of your tax liability.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth. So find out if you qualify at peoplescapitalgroup.com.
Yeah, yeah. No, the tax system is incredible for real estate owners, and we have a number of exits that we realized last year and this year as we sell some buildings that we've stabilized over the last 4 or 5 years. And some investors have done very well on those. And now we've offered them new investment opportunities, which we do cost segregation studies on, so we can front load that tax depreciation on the new acquisition and use that to write off the gains on the previous exit, as long as it's done in the same calendar year there. And that's a great way for these, passive investors that are going from a passive exit to a passive investment with us to write off those gains, and also the cash flow, to avoid any taxable tax burden on the cash flow they're earning on these passive investments. You can use those passive tax write-offs to write off the cash flow. But what you're explaining, Isaac, is incredibly sophisticated and smart, and I think could be a whole masterclass in itself of how married couples can use. I mean, obviously you want to have a good relationship with your spouse, that probably should be chapter 1 of this lesson. Make sure your marriage isn't on the rocks. That could be a mess, but how could you use, the relationship of maybe one spouse that works very part-time or is a homemaker and able to then qualify as a real estate professional in one way or another. I've seen people buy a beach house and do Airbnb, and now they get their 750 hours that way, and so on. And now they get that, they can write off active gains, because they're managing the Airbnb and so on. And you get a beach house. It's kind of fun. So there's lots of different strategies there. In fact, I know an RIA that does that, and he's crushing it, completely writing off his active gains with this RIA business by owning a beach house and managing it on Airbnb. And he's able to then write off his gains, his active gains from his business of managing other people's money as an RIA. So obviously you want to talk to a wealth, really a CPA, professional who can guide you in this process. I'm sure Isaac can put you in touch with one of those as well. Madison Specs does all types of services there, accounting, cost seg, and so on. So that's really interesting. Okay, so then that was a nice deep dive into different ways to utilize passive tax write-offs and active tax write-offs. And, I actually did a whole masterclass on the lazy 1031, which is essentially when you sell a property, you have a tax burden, then you buy another property in the same calendar year and you do a cost seg on that new acquisition, and you use those accelerated tax depreciation to write off your gains on the last sale, which we call a lazy 1031. That's a special buzzword for it that millennials are using. So you could, that's a good way to get some hits there on your LinkedIn profile. And but let's talk about the changes in the law here, because bonus depreciation, you used to be able to take 100% bonus depreciation, right? So essentially you can get a lot more of a tax write-off through a cost segregation study. Then the last administration came into office and for some reason decided to lower that and kind of phase it out. Then it was 80% one year, then it went down to 60%. Now I think it's 40% bonus depreciation. So essentially you're allowed to take less and less bonus depreciation from this cost segregation study. So the bottom line is you get less of a tax write-off. Now, the new administration is a little more business friendly. And of course, Donald Trump is a real estate investor and understands the value of this cost segregation law and bonus depreciation. So what's the rumblings on the street? Are they trying to bring back 100% bonus depreciation? Because if that's the case, Isaac, you're going to be crushing it. Everyone's going to run out and order their cost seg. As me first in line, of course, because that's going to be amazing to get 100% bonus depreciation back. What are we hearing is going to be the possible change in law there?
Love this conversation. So I'm going to backtrack for a minute. So when bonus depreciation started phasing out, a few people approached me like, Isaac, you're looking for a job. Maybe you could be a gas station attendant. And if you need any help, call me. And I said to them as follows. I said, prior to September of 2017, okay, bonus depreciation was only introduced in September of 2017. Prior to then, cost seg nationwide was still a multi-billion-dollar industry. The reason being is that even if you completely wipe away bonus depreciation, regular cost seg, which lets you accelerate certain components to the 5 and 15-year bucket, which lets you take them over a period of 5 and 15 years, bonus really lets you elect to take that most of that in year one. But even without that, it's definitely still worth it to do a cost seg. And any building that's purchased, I would say, for 3-4 million and above, definitely worth it to do a cost seg, because you might not be able to get, in my example, the $10 a year, you might not be able to get $30 year one, but you might be able to get over the first 5-7 years of ownership of the property, you might be able to get out of that $100, maybe $50. Sorry, that's over 5 years. So let's say you get 70, right? You're still going to get a nice amount of it. Mm-hmm. You won't be able to get as much, but still a nice amount. Mm-hmm. So just keep that in mind. So even if somehow bonus depreciation next administration phases out, cost seg through regular accelerated depreciation can still get you a substantial amount of benefits. Mm-hmm. That being said, Aaron has a great point. And there's been a lot of rumblings, a lot of talk in the street, what's going on in Congress. So just to give you a summary and just a rewind and let you know really what happened. So 2017 bonus was introduced. So starting from September 2017, 2018, 2019, 2020, 2021, 22 had 100% bonus. That means anything that we find in the property as components that we can accelerate, you can take that all on year one. Okay. Mm-hmm. Starting January 1st of 2023, bonus went down from 100 to 80. Okay. That means if we find 20% of the property's purchase price net of land as components that we can accelerate, you can only take 80% of that 20% year one. What happens to that extra? Usually you get it over years 2, 3, 4, and 5. So you're still going to get it in the earlier years, but not everything year one. 2024, that went down to 60%. Mm-hmm. We find, again, same example, we find 20% of your property's purchase price net of land as, I don't think this is a word, but acceleratable components. I always use that. You can go ahead and take 60% of that year one. Mm-hmm. Again, that additional 40, that leftover 40 is going to come to you in years 2, 3, 4, and 5. Now, 2025 went down to 40%. So we're talking about the difference between 2022 and 2025 is close to half. Sorry, even less than half. That means you buy a $10 million property in 2022. You buy 123 Main Street for $10 million, and we get you $2 million. In 2024, you're looking at 800,000, 850. You're looking at less than half. So your pitch to your investors is not as strong. Your pitch to yourself in terms of what entices you to buy because you want depreciation benefits as well is just not as enticing. Mm-hmm. There's a lot of talk on the street, and they really tried to introduce this last year to bring back 100% bonus, and it was part of the big tax package, and it didn't pass. I don't even think it didn't pass. I think it just got stalled. They got busy with more important things, and now Trump is making a big push for this, and obviously because the House and the Senate are both red, the president is red, so therefore it looks like it will happen. They're very business friendly. They want these tax cuts because again, it fuels the economy. So 100% bonus is on the table to come back. It looks like it really will happen. I place my bets on it that it will. And like Aaron said, it really is a game changer because yes, cost seg without bonus or even half a bonus could be exciting, but how much more exciting is it to double your money, right? Yeah. I'll take $20 over $10 any day of the week. Mm-hmm. So if I can go ahead and really pitch to my investors, you're going to get dollar for dollar. You invest $100,000 and I'm going to give you $100,000 in benefits versus giving you $50,000 in benefits, 50 cents on the dollar. That's just definitely more exciting and enticing for somebody to invest in real estate versus the stock market. Because you go ahead and you take away the tax benefits, real estate might be more lucrative, but depreciation is a big swing, is a big talking point between stock market and real estate. So definitely a greater talking point, and even for small, not even, I would say specifically for small investors, it makes it's really a deal breaker. You buy a $500,000 Airbnb beach house like Aaron was talking about, and you can get $150,000 versus $75,000 year one. That's a make it or break it if you're going to do a cost seg. So for me, it's definitely beneficial. For you, it's very beneficial. But again, even for regular syndicators and their investors, 100% bonus can be a real game changer. Let's pray, fingers crossed, that this happens. I think it will happen. But again, just as a reminder, even if it doesn't, Cost Seg is a very, very valuable item because you will get that 100% bonus over the course of the first 5 to 7, 8 years. So you're still talking about a big, big chunk. Obviously, I would elect every single day of the week to take 100% bonus versus versus taking 40 and the rest over time.
Yeah. Yeah, absolutely. And it'll just really fuel the economy. I mean, when we buy an apartment building, we create so many jobs. We're hiring contractors, we're hiring cost segs, lawyers, brokers, title companies, lenders. Oh my gosh, materials. The list goes on and on. Due diligence companies, environmental companies, inspections. It's just it's crazy. Leasing agents and banking and everything. I can't tell you the amount of companies that we work with. Marketing companies to raise the capital, SEC attorneys, eviction attorneys, the whole thing. Man, it goes on and on and on. And renovating units, leasing them up for a higher market value increases. Different tax revenue to the property tax. Oh my God, oh my gosh. It's like so many benefits when we turn real estate, when we buy real estate, when we improve real estate, and that incentive to essentially double the amount of bonus depreciation we can take now, even more than double it, is phenomenal. That'll encourage us to buy more real estate. It'll encourage more people to invest in real estate because the benefits are just that much greater. And it'll create an exponential increase in economic activity and jobs and so on, and property values. So really hoping for that as well. And I think it's going to happen here. So I'm excited for that. So Isaac, incredible podcast here. We've covered a lot of information about the different types of tax write-offs one can take, the passive versus active, different strategies to become a real estate professional and utilize, tax strategies to really take full advantage of that bonus depreciation and the tax benefits real estate offers. And then also what we might see for bonus depreciation coming back in swing here at 100%, which would, boy, you'd be a busy man. You need to hire a few more people under you. You'd be working late nights. You'd have to tell your wife, sorry, honey, I'm bringing home the bacon. I'm going to be home at 9 o'clock tonight. Leave dinner out for me. She's not going to
combine that with some lowered interest rates, God willing. Boom, we got.
Oh my gosh, me and you are going to be sitting pretty. We're going to be doing well for our clients and so on. So, but Isaac, I really do appreciate you're sponsoring our event here on June 25th in Somerset, New Jersey. By the way, anyone listening, if this might be out after that, but check out our real estate network, their New Jersey Real Estate Network, for more events. But I appreciate all your support through and through. How can people reach out to you and learn more about your services?
My wife tells me that she wants to get a hold of me. She messages me on LinkedIn.
Okay, there you go. There you go.
So I'm a big LinkedIn guy. Connect with me on LinkedIn, but obviously, Aaron, you can put in the notes my phone number and my email address. I'd love to talk to each and every single one of you about your situation, whether you're a $200,000 Airbnb guy or whether you're focusing on $70 million acquisitions of Class A multifamily. So I've dealt with them all, and I'm excited to chat with you, and I hope you enjoyed this podcast as well.
Thank you, Isaac. Yes, we will put your website there. We'll put your phone number, your email in the show notes so everyone can reach out to Isaac directly and find him on LinkedIn. He's a fun guy to follow there. Isaac Weinberger, a nice Jewish boy, really, really good gentleman here. So no, you're a good man, Isaac. I always appreciate doing business with you. You run an honest business over there, and you certainly know your taxes. I got to say, I've learned a lot from this podcast. I love that when I do a podcast and I learn things, do my own podcast. It's I feel like I'm double dipping here. It's great. So
I appreciate it. I appreciate all the love. I really
absolutely do. Yes. And to our listeners here, if you're finding value in these episodes, all I ask is that you share them with a friend, a colleague that would also find value in these episodes of the Passive Cash Flow Podcast, and like and subscribe on the platform that you're listening on. Check us out on YouTube, People's Capital Group. And of course, I'm the co-founder of People's Capital Group here. My name is Aaron Fragnito. We help people build and preserve their wealth through New Jersey apartment buildings. So a lot of our investors are local to New Jersey, but not all of them. We're buying a large 78 unit in Hackensack, New Jersey right now. If you want to learn more about that, contact us. You can learn more at peoplescapitalgroup.com. And we come out with a new episode of the Passive Cash Flow Podcast every 2 weeks. So keep subscribed here, keep listening, and reach out to Isaac Weinberger here. He's going to be able to save you money on your taxes legally. Avoid paying the tax man. So unless you really love paying taxes, you should contact Isaac today and he can help you out. How's that sound, my friend?
I love it. I love it.
Absolutely. All right. Thank you, my listeners. Enjoy your day.